On the morning of September 15, 2008, 25,000 employees of Lehman Brothers walked into their offices at 745 7th Avenue, New York City, carrying their coffee cups, checking their emails, planning their weekends. By the evening, they were walking out carrying cardboard boxes. Their jobs were gone. Their savings, invested heavily in company stock, were wiped out. And the firm that had survived the Civil War, 2 world wars, the Great Depression, and every financial crisis for 158 years simply ceased to exist. To understand how Lehman Brothers died in a single day, you need to go back a few years. In the early 2000s, the American housing market was booming. Banks were giving home loans to almost anyone, even people with poor credit and no proof of income. These were called subprime mortgages. Wall Street bundled thousands of these risky loans into complex products called mortgage-backed securities and sold them to investors worldwide. Ratings agencies stamped many of them with their highest rating, AAA. Everyone was making money. Nobody wanted to ask difficult questions. Lehman Brothers, under CEO Richard Fuld, dove deeper into this game than almost anyone. Fuld was known on Wall Street as the gorilla, famous for his aggressive style. He pushed Lehman to buy massive amounts of real estate and mortgage-related assets. At its peak, Lehman held over $600 billion in assets, but was borrowing more than $30 for every $1 it actually owned. At that ratio, even a small drop in asset value could destroy the entire firm. By 2007, housing prices began to fall. Homeowners started defaulting. The mortgage-backed securities were now losing value rapidly, and Lehman was sitting on tens of billions of dollars worth of these toxic assets. In the second quarter of 2008, the firm reported a loss of $2.8 billion. The stock price, which had been above $65 in early 2007, was in free fall. Richard Fuld desperately searched for a lifeline. He approached Warren Buffett, who studied the books and walked away. He reached out to Korean and Chinese investors. Those talks collapsed. He then turned to the only 2 realistic buyers, Bank of America and Barclays. Now we arrive at the final weekend, September 13 and 14, 2008. Treasury Secretary Henry Paulson and Federal Reserve President Timothy Geithner summoned every major Wall Street CEO to the New York Fed building. The message was blunt. The government was not going to bail out Lehman Brothers. Wall Street had to solve this on its own. Bank of America was interested, but Merrill Lynch, another collapsing giant, made a separate approach. Bank of America chose Merrill Lynch instead, leaving Lehman with only one option: Barclays. Barclays was willing, but under British regulations, it needed a shareholder vote before guaranteeing Lehman's obligations. Lehman did not have weeks. The British regulator refused to waive this requirement, reportedly unwilling to import America's crisis into Britain. With that decision, Lehman's last hope vanished. On Sunday evening, the board made the decision nobody wanted. At 1:45 in the morning on September 15, Lehman Brothers filed for Chapter 11 bankruptcy with $613 billion in debt, the largest bankruptcy in American history. That record still stands. When markets opened Monday, chaos erupted. The Dow fell over 500 points. Insurance giant AIG, exposed through billions in credit default swaps, needed an emergency $85 billion government bailout within 24 hours. The Reserve Primary Fund, a money market fund holding Lehman debt, broke the buck, meaning ordinary people's safest investments were suddenly at risk. Credit markets worldwide froze. Banks stopped lending to each other. Businesses could not get loans to pay employees. Within weeks, the United States passed the $700 billion TARP bailout. Britain nationalized several banks. Iceland's entire banking system collapsed. The crisis wiped out an estimated $22 trillion in American household wealth. Millions lost their homes. Unemployment hit 10%. Richard Fuld was called before Congress on October 6, 2008.
When questioned about earning nearly $500 million while the firm took on catastrophic risks, Fuld disputed the figure, claiming it was closer to $310 million. The distinction calmed no one. No senior Lehman executive was ever criminally charged. A court-appointed examiner later found Lehman had used an accounting practice called Repo 105 to temporarily hide billions from its balance sheet, making the firm appear healthier than it was. Prosecutors determined these practices, while deeply misleading, did not meet the threshold for criminal fraud. The collapse of Lehman Brothers was not just one bank failing. It was the moment the world discovered the global financial system was built on risk almost nobody fully understood. One institution, large enough and connected enough, pulled the entire world economy to the edge in just 24 hours. And the most chilling part is the simplest. Every warning sign was visible for months, even years. But the people with the power to act chose to believe the music would never stop, until it did.